Good afternoon, everyone, and thank you for having me here today. My name is Justin Petrus, and I'm with MGO. We are the investment advisor and the plan administrator for the Quadax 401k plan. So thanks again for being here today. I know everybody's schedule is jam-packed, so I do appreciate you taking the time to kind of step back here and look at the bigger picture. My goal here today is to give you some clarity, not predictions, not guesses, but clarity. We're going to walk through what actually happened in 2025. And that's a word that I want to emphasize, actually, because the headlines told one story, but the data often told a very different one. And when you're making financial decisions, the data is what matters, not the headlines. So then we'll shift into what all of this means for 2026, not in a crystal ball kind of way, but more in a practical planning focused type of way. What should we expect? What should we ignore? What should we prepare for? The whole point of this conversation is to help you make your decisions based on facts and not fear or headlines. Markets are always going to surprise us, but good, solid planning reduces the impact of those surprises. So think of this as a chance to zoom out, reset, and look at the year ahead here with a little bit more of a clear lens. When you look at 2025 from a high level, the theme that jumps out is resilience. And honestly, that wasn't the expectation going into the year. So at the start of 2025, a lot of economists were calling for a recession. Consumer sentiment surveys were weak. Inflation was improving, but still uncomfortable. And interest rates were sitting at levels that we haven't seen in more than a decade. But here's what actually happened. GDP growth came in around 2.1%, which is solid, steady growth, definitely not recession territory. Unemployment stayed near 4.1%, which is still a historic low. Inflation continued moderating, coming in around 2.4%, which is much, much closer to the Fed's 2% target. And despite all of the noise, consumer spending actually held up. People didn't stop spending, they just became a little bit more selective. So when you zoom out, the economy didn't break, it adapted. It slowed in a healthy type of way, and it showed the level of stability that surprised a lot of people. The volatility that we saw, I don't think was a sign of weakness. It was just the market adjusting. And that's a good thing for the long term. Markets in 2025 were a really good example of why staying invested matters. So let's talk about some numbers here. And the S&P 500 had a return of about 17.9% if you include dividends. In the spring, the market actually dropped more than 16% after tariff announcements, and then it ended up recovering, of course. Emerging markets were the top performer, returning a little bit over 34% in dollar terms. And this is the first time in years that all major asset classes actually delivered positive returns. So that's stocks, bonds, international markets, everything. But the path obviously wasn't very smooth. Market leadership did narrow, so we had a smaller group of companies carried a larger share of the performance. And this is something that typically creates concentration risk, but it also creates emotional whiplash for people who are trying to chase what has worked in the past. So bonds finally mattered again. So after years of super low yields, 2025 brought back a real level of income, which is nice to see. So yields were high enough that bonds provided both stability and return, which is exactly what they're supposed to do. And it's something that we haven't seen more recently. So the big takeaway here is that returns were there, but they required some discipline. You had to stay invested through all of the noise and kind of deal with the volatility as it came. Economically, 2025 had a few very clear themes that ended up shaping the entire year. So inflation cooled, but not evenly. So goods inflation came down quickly, but services, so think of healthcare, insurance, housing, they remained elevated. Those categories don't respond quickly to rate changes, so they do take a little bit longer to normalize. We did see consumer spending slow, but it didn't collapse. People were still traveling, they're still going out, they're still buying things, just with a little bit more intention. We did see a shift towards value and experiences, and that was for consumer spending. The labor market normalized, so we had job openings come down, wage growth cooled slightly, and hiring slowed. But none of this is necessarily a negative. You can't run a labor market at full throttle forever. It's just not possible. And a little cooling off is a healthy thing. Corporate earnings shifted. So instead of growing through expansion, companies decided to grow through efficiency, cost control, productivity, smarter operations. That's what you see in a maturing economic cycle. And globally, world GDP growth is expected to be around 3.2%, with emerging markets leading the way. So the global backdrop was steady, not necessarily spectacular, but it was supportive. 2025 also reinforced some timeless lessons, lessons that people tend to forget when things are kind of going smooth and are much more calm. So, first things first, markets do not move in straight lines. So, we had strong months followed by sudden pullbacks, often with no major change in fundamentals. Second, headlines are terrible investment signals. If you reacted to the tariff news in April, you probably sold at the bottom and missed the rebound. Third, timing the market still does not work. Some of the best days of the year ended up happening right after some of the worst days of the year. Fourth, diversification finally mattered again. Emerging markets outperformed the US for the first time in years. And like I said before, bonds contributed in a meaningful way. International markets added value. And finally, discipline is something that ended up winning out. So people who stayed patient generally came out on top of those who tried to outsmart the market in one way or another. So the data makes this clear. Staying invested beats trying to outsmart the market the majority of the time. And there's an old adage that says it's more about time in the market and not trying to time the market. Looking ahead here at 2026, so the key here is to set realistic expectations. So this is what the Fed is projecting here is GDP growth slowing a little bit to about 1.9%, inflation moving closer to that 2.2% target, unemployment ticking up to about 4.2%, and then rate cuts beginning, but gradually. So the most likely scenario is going to be slower and steadier growth, not a boom, not a bust, just more of a normal market environment. And that is actually something that is healthy. So the post-COVID years were unusually strong. What we're moving into now is going to be much more of a sustainable pace. Rates again are going to stay in the spotlight this year, but the important thing to remember here is that markets usually price in rate cuts before they actually happen. So the Fed now expects the federal funds rate to move from 4.6 in 2025 down to about 3.6 in 2026. So that is meaningful, but it's not a dramatic shift. Inflation risks haven't disappeared yet. They've just become a little bit more concentrated. Energy, housing, geopolitics are going to be the main areas to watch for inflation. For bonds, stability alone can be a huge positive. You don't need to have massive rate cuts for bonds to have a good year. You just need a little bit of predictability. Every year is going to bring some risks to the table. And of course, 2026 is not going to be any different. Geopolitical tensions, those are going to remain a wild card. Policy uncertainty, especially in an election year, can definitely create some short-term volatility. Concentration risk in major indices is something that we should all take seriously, especially after a year where just a handful of companies drove the large share of market returns. So the Mag 7, which right now currently makes up right around 35% of the S&P 500. So the Mag 7 is going to be Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. But there are going to be opportunities too. So the S&P's global outlook highlighted improving growth in Europe, Japan, and emerging markets. Income strategies look stronger now with yields being elevated. Risk managed portfolios can add real value in a moderate return environment. So the goal here isn't necessarily to eliminate risk, but it's to manage it with intention. Planning changes often matter even more than market moves. So here's some of the changes here going into 2026. We did have some contribution limits that are increasing for this year, giving more people room to save. So the max 401k contribution is now going to be $24,500. The age 50 plus catch-up is $8,000. Now, if you happen to fall within ages 60 to 63, there's a thing called super catch-up, which actually increases that catch-up amount to 11,250. And then the IRA contribution limits rose up to $7,500. So the budget office outlook shows steady wage growth and stable employment going into the year, which supports stronger cash flow planning. With inflation cooling and rates expected to fall, 2026 is a great year to revisit long-term planning assumptions. Things like expected returns, expected withdrawal rates, savings targets. We're able to kind of normalize these return rates or expectations a little bit more realistically. And these are the areas where small decisions end up compounding over time. So what does this mean for your plan? So it means focusing on things that you can control, your savings rate, your diversification, your tax efficiency, your time horizon. It means building a portfolio around your goals, not around headlines. And it means that using volatility as a tool. So in 2025, like I was saying before, the S&P dropped over 16%, followed by an 18% gain, which created multiple opportunities for participants and investors to rebalance. If you have a taxable account to harvest some tax losses. A good plan evolves with your life, again, not around the news cycle. So I wanted to put my information here on the screen. So if anybody here has any questions, apologize. If anybody here has any questions, comments, concerns, anything that I can do for you, please shoot me an email or give me a call at my direct line. I'm always happy to help. If you have accounts that are outside of the Quadax 401k, like an old employer's 401k, a traditional IRA, a Roth IRA, and you wanted to get a second opinion on it, I'd be more than happy to take a look at it and give you my opinion and kind of see what may make most sense for you. If you have questions about the market in general, or you're interested in signing up for our managed account service, just give me a ring and we can get you set up on there. So again, anybody needs anything, let me know. But thank you for your time here today, and I will see you at the next webinar. Have a good day.